dollar is under pressure, the US bond market is flashing warning signs, and now there's a new twist. Trump has slapped a huge tariff on imported gold. Real money itself is being targeted. This move isn't just about trade, it's about reshaping how Americans can protect their wealth, and it's already sending shockwaves through global markets. We're watching several storms collide at once. The bond market, the backbone of US borrowing, is stumbling. Auctions for long-term debt are coming in weak, pushing yields higher and making it more expensive for everyone to borrow. From families buying homes to businesses trying to expand. At the same time, tariffs are spreading across imports, straining trade relationships and driving prices higher at home. And the timing couldn't be worse. In 2025, inflation is still biting, interest rates remain high, and economic growth is slowing. The national debt is already at historic levels, and instead of easing the strain, these new policies are adding more weight. The mix of financial stress, geopolitical tension, and now direct attacks on gold imports is creating a dangerous feedback loop, one that could reshape the dollar's role and the balance of power in global markets. The US bond market has just sent one of its clearest warning signals in years. At the latest 30-year bond auction, demand came in weak, pushing yields close to 4.9%, the highest in over a decade for that maturity. Long-term investors, the kind who usually lock in these bonds for stability, are stepping back. That's a problem because these buyers are the backbone of funding America's massive debt. The 10-year auction, often called the benchmark for borrowing costs, wasn't much better. Yields climbed to about 4.28%, with demand falling short of expectations. This matters far beyond Wall Street. Mortgage rates, credit card interest, auto loans, all of them are tied to the movement of the 10-year. When yields rise, so does the cost of living for millions of Americans. Scott Bessent, in charge of Treasury borrowing, isn't issuing much fresh debt for growth. Most of what's sold now is just refinancing older bonds that are expiring, like rolling a snowball that keeps getting bigger downhill. To keep Washington running, the Treasury has turned to short-term debt. This week alone, it plans to sell $100 billion in 4-week bills, the largest amount since 2023. That's a sharp jump from the pre-2020 norm of around $40 billion per sale. History shows that spikes like this, such as in 2009 during the financial crisis or in 2020 at the height of pandemic spending, signal stress. The more the US relies on short-term borrowing, the more exposed it becomes to sudden swings in interest rates. It's a fragile setup, one where a single shift in investor sentiment could send borrowing costs even higher, adding more pressure to households already stretched by inflation and high prices. This tightening noose is setting the stage for the next big economic shock. Tariffs are often sold as a tool to protect local jobs, but in today's global economy, they can quickly turn into a boomerang. When the US raises tariffs on imports, foreign governments don't just accept the hit, they respond. They buy less from American companies, look for alternative suppliers, and in many cases, strengthen trade ties with US competitors. That's already playing out in 2025. Major buyers like India, Brazil, and South Africa are deepening deals within BRICS, replacing US goods with cheaper alternatives from China or other emerging markets. In sectors from machinery to agricultural exports, orders are falling. For American farmers, manufacturers, and exporters, that means fewer contracts, slower production, and eventually layoffs. Meanwhile, the revenue Washington collects from these tariffs is nowhere near enough to offset the damage. According to the latest Treasury data, tariff income covers only a fraction of the government's spending gap. The shortfall is being plugged by more borrowing, and not the safe, long-term kind. Short-term borrowing is like living on a credit card that needs to be paid off every month. It works for a while, but it leaves you vulnerable to sudden spikes in interest rates. If investor confidence wavers or foreign buyers pull back further, the cost of rolling over that debt will climb, and fast. So instead of strengthening the US position, the tariff war is making the country more dependent on quick cash, while alienating the very markets that once fueled its export economy. And as foreign trade flows shift away, the pressure on domestic prices and household budgets only gets heavier. For millions of Americans, the tariff war isn't an abstract policy debate. It's something they feel every time they walk into a grocery store. A recent survey shows 53% of households list grocery costs as a major source of stress. And it's not hard to see why. Imported staples like coffee, fresh vegetables, and fruit now carry added tariffs, pushing prices higher. The idea was to encourage local production, but farmers are dealing with their own cost crisis. Fertilizer, fuel, and equipment prices have jumped sharply since 2024, driven in part by higher global energy costs and disrupted supply chains. These expenses get passed straight to consumers, so even Made in America products are becoming more expensive. The pinch isn't limited to food. Housing costs remain near record highs, with mortgage rates still tracking elevated bond yields. Utility bills have climbed as energy prices stay volatile. Healthcare expenses, already the highest in the developed world, are rising faster than wages. The average American family is now spending more than a third of its monthly income just to cover housing and groceries, leaving less for savings, debt repayment, or discretionary spending. This financial squeeze changes behavior. Families are cutting back on fresh produce, delaying home repairs, and skipping routine medical care to make ends meet. Retailers are seeing smaller shopping baskets and fewer visits, a clear signal that disposable income is vanishing. All of this creates a ripple effect through the wider economy. When households pull back, local businesses feel it. Restaurants lose customers, service providers see fewer bookings, and small-town economies slow. Inflation may no longer be accelerating as fast as in 2022, but the damage from high prices is cumulative. And for Main Street, the pressure is only intensifying as trade tensions drag on. But U.S. Commerce Secretary Lutnick claims everyone in the world is paying these tariffs, except Americans. It's a bizarre statement and a clear reminder of the kind of logic driving decisions on Capitol Hill.
And let me tell you who the experts are. Donald Trump and his trade team have proven the EU pays, Japan pays, Korea pays, Vietnam pays, the Philippines pay, Indonesia pays, and the list, by the way, we did like 5 deals. Donald Trump solved a war between Thailand and Cambodia.
And it's that same thinking that's now reached one of the oldest and most trusted assets in history, gold. Long seen as the ultimate store of value, a form of real money beyond central banks and political promises, it's now in the crosshairs. The Trump administration imposed tariffs on imported gold, specifically on 1 kilogram and 100-ounce bars. The new tariff will raise the cost of gold for U.S. buyers by nearly 39%. That's a staggering increase in a market where margins are already tight. In 2024, the U.S. imported roughly $16 billion worth of gold, with the bulk coming from Canada, 28%, Switzerland, 13%, and Australia, 7%. All of these suppliers will now see their exports priced out of reach for many American investors and jewelers. The impact is already visible. Gold futures in the U.S. have surged to record highs, and the gap between U.S. futures and the global spot price has widened to about $120 per ounce, the largest divergence in years. This means Americans are paying significantly more than buyers in markets like Singapore, Hong Kong, or Dubai, where gold can still be purchased near the global benchmark without such tariffs. For smaller investors, the pain won't stop with large bars. Higher costs for wholesale imports will eventually filter down to coins, jewelry, and even collectible bullion products. Premiums on popular American gold eagles, for example, are expected to rise sharply as dealers adjust to reduce supply. For ordinary savers trying to protect themselves from inflation or currency risk, the barrier to entry just got much higher. Meanwhile, the rest of the world is moving in the opposite direction. Countries like China are aggressively buying physical gold, not only for private investors but also for central bank reserves. With U.S. demand set to drop, more of the global supply will flow east, often at discounted prices. This shift will strengthen China's influence in global gold pricing and reduce America's role in setting international benchmarks. By making gold harder and more expensive to obtain domestically, the U.S. risks isolating its investors from one of the most trusted hedges against financial instability. And as this new policy plays out, the question becomes clear. Who really benefits when the world's most reliable form of money is taxed out of reach at home? The gold tariffs may hurt American investors, but they're a gift to China. With U.S. demand set to drop, more of the global supply will be redirected to Chinese buyers, both private and state-backed. For Beijing, this isn't just about securing a commodity. It's about building strategic reserves. The People's Bank of China has already added over 300 metric tons of gold since early 2023. And these new market conditions make it easier to buy even more, often at favorable prices. This shift also chips away at America's influence in global gold pricing. For decades, U.S. futures markets like COMEX played a central role in setting international benchmarks. But as liquidity moves toward Asian hubs, price discovery will increasingly happen outside the U.S. That means Washington will have less sway over a market that underpins confidence in currencies, especially in times of crisis. At the same time, the policy aligns neatly with broader de-dollarization trends. BRICS members are openly discussing gold-backed trade settlements, bypassing the dollar in international transactions. If China strengthens its gold position while the U.S. restricts its own access, the balance of financial power shifts further toward emerging economies. In effect, a tariff meant to generate revenue is accelerating a global realignment, one where America's role as the world's financial center faces its strongest challenge in decades, and its rivals are more than ready to step into the gap. America's debt load is no longer just growing. It's compounding at a pace that's becoming harder to control. Even if the Federal Reserve cuts rates in the months ahead, the sheer volume of borrowing means those moves may not bring yields down enough to ease pressure. The U.S. is increasingly financing itself through short-term debt, which must be rolled over constantly. That leaves the entire system vulnerable to sudden jumps in interest rates or shifts in investor sentiment. Keeping more dollars locked inside the country to fund this borrowing comes with its own cost. With fewer dollars circulating globally, the domestic supply piles up. That extra liquidity doesn't stimulate growth. It pushes prices higher at home. Inflation may have cooled from the peaks of 2022, but core costs for essentials like housing, food, and healthcare remain well above pre-pandemic levels, squeezing household budgets. The divergence in PMI data tells the same story. While much of the world is seeing input prices stabilize or even decline, U.S. producers and service providers continue to report rising costs. This gap shows how tariffs, borrowing, and trade isolation are creating a higher cost environment in America compared to its trading partners. Left unchecked, this cycle erodes the standard of living. Wages struggle to keep up, savings shrink, and basic expenses take a larger share of income. What we're watching isn't just a short-term squeeze. It's the makings of a long-term structural decline that will be far harder to reverse once it takes hold. The signs are everywhere: rising yields, shrinking trade, gold flowing overseas, and a debt machine that can't slow down. Every lever pulled to keep the system going adds more pressure somewhere else. At some point, that pressure will break something, and when it does, the fallout won't stay on Wall Street. It will hit every household budget, every savings account, and every paycheck. So ask yourself, is this strategy preserving America's strength or draining it away piece by piece? Share your thoughts below, subscribe, and stay tuned as we track how close we are to crossing that breaking point.